What if we retired at 65 instead
What
of
if one of us
67?
needs long-term care in our 60s?
What if we downsize our home now instead of waiting?
Welcome to another episode of the What If Show, brought to you by Thomas Gold Solutions, the team behind Retirement Analyzer, the refreshingly simple software for financial advisors to use when developing and managing retirement plans for your clients. Last episode, we went on a deep dive about life insurance. This episode, which has some related tones to it, we have our first ever guest, Bob Tranchell, a home equity retirement specialist with 23 years in the business and the RICP designation. This is going to be a fantastic conversation to look at retirement planning through a completely different angle. What is the most powerful tool in your client's retirement plan? It might not be in their portfolio. What is the house that they're living in actually worth? This is really exciting stuff. So I'm super excited. Brooke and Steve, this is our first guest. I can't believe it. I'm pumped for this. I guess let's dive into it. I'll kick it off with you guys.
I just want to let everybody know I have goosebumps.
That's awesome. So why was it so important to have Bob on the show? By the way, Bob, welcome to the show, buddy. It's great to see you.
Great to be here. Always enjoy being with Steve and Brooke, and great to meet you, Mike. Looking forward to the session.
Awesome. Bob. Yeah, and just a little bit of background. Steve and I have worked with Bob for, I bet Bob 5+ years now. Is that right?
Yeah.
And we really don't have any affiliation with him, but he has been such a great referral partner for us. He's just an absolute expert in this space. And we do have a lot of retirement analyzer advisors that have used him as well. So again, thanks, Bob, for being here. We're just happy to have you.
Thank you.
Yeah, and I'm glad to have Bob on too. We worked together for a while now, and really the concept's amazing. You have to open up the clients' minds. We talked about last episode the negative connotation with life insurance. How do you get through that? Well, now we have home equity, right, and a home equity loan. Right. And a lot of people are like, oh, they're going to take my house and stuff like that. Bob's going to talk a little bit about that. But if you can get by that, I think this thing makes a heck of a lot of sense. I think that's what Bob's going to detail a little bit here today. Yep.
Super. And I think, Bob, that's kind of a natural place to start. You want to talk about the misconceptions kind of around this HECM concept and what advisors most typically are going to face there?
Sure. It's funny. The reverse mortgage has a lot of stigma attached to it. And a lot of that really stems from past sort of poor iterations of reverse mortgages that go back to the 60s, 70s. In 1987, though, Congress legislated FHA to insure these products, and then it became like any other loan. We have a lien on the property, just like a HELOC or a 30-year fixed or something like that. But today, I still face, when I talk to somebody about a reverse mortgage or the HECM, they'll say, oh, that's the one where the bank takes the house. And that's just not true anymore. The modern reverse mortgage is a mortgage just like any other mortgage. We have a lien on the property, but it's your property. You maintain title. You can do whatever you want with it. And we don't have much of a say what you do with your loan or with your home. So it's very much like any other mortgage from that standpoint. So I think that's number one issue that comes up. I think the other one for financial planners and for clients alike is that the closing costs on a HECM are higher than they are on a traditional, either a HELOC or a conventional loan. But what I like to really encourage people to see is it's really kind of an opportunity cost. When you look at the closing costs, and they are high because of the mortgage insurance premium, you have to consider it in the plan overall. And when you see the impact it has on the retirement plan, then the closing costs become a very palatable aspect because you're giving a much better outcome, and the closing costs are not as big a hill to climb from that standpoint. So that's the second one. I think the third one, and this one is kind of going away with the baby boomers. In the past, everybody was like, oh, I want to leave the house to my kids. The baby boomers are a little more, you know what I've done for my kids through the years? And they're a little more on the line of, let's take care of the mothership now, and they'll take care of themselves. But statistically, only about 30% of the kids actually want the house. The other 70% are going to sell it and take the equity out. And so that doesn't get hindered by a HECM in any way. And so those are three stigmas, things that come up. The fourth one is really financial planning related, and that is that most financial planners consider the HECM as a last resort. They say, okay, we're going to wait till the portfolio exhausts. We're going to wait till there's a long-term care event, and then we'll engage the HECM. And that actually has been shown to be the least effective way to engage the HECM and put it into a retirement plan. So those are kind of the upfront stigmas and myths and things that I face every week. And, when you understand the full picture, they kind of go away.
Yeah.
Can I ask a question though? So, you talk to a lot of people about this concept though. So how many people are still surprised using, Mike was talking about like the biggest asset a client has, and a lot of times it is their home. But do you think people are thinking about this stuff more now? Or, are they still shocked like, oh my God, I could use my home? Wow, this is great.
Yeah, it's interesting to me. I think that what I'm surprised by is how many financial planners aren't having the housing conversation. They're not talking to their clients and saying, okay, what's your long-term plan with the house? Are you planning on moving? Are you getting a second home? What will happen when one of you passes away? Will the other one remain in the home? And so I think from a financial planning perspective, most people leave the house as sort of an invisible thing that you might tap into sometime, but they're not really having the conversation up front with their clients. And then from there, engaging it if it's appropriate.
It's really interesting here is I feel like I'm going to steal two topics here that kind of tee up this conversation. There's this concept that you hear people say often, like, stop treating your house like it's an asset. It's your house. I've heard that over and over again over the years. You hear it from quote unquote financial people and in the media and so forth. Treat your house as a home. It's your home. It's not your asset. But part of the reason why we're having this conversation is there's a lot of people who are suddenly, on paper, very wealthy because of their house. We were joking before we clicked the record button that there's lots of neighborhoods in America that probably have no business having multiple listings of $1 million properties that have $1 million properties. And so people over the course of the last, since the pandemic, have seen their house go up by 50% or sometimes double in value. That's a lot of their asset wealth sitting there in their home. To your knowledge, what's the average, amount of someone's net worth that's tied up in a house?
Yeah, I think statistically it's somewhere between 40 and 80% of the total net worth for baby boomers.
Wow.
And, I live on Cape Cod, and what we saw during COVID was absolute ridiculousness. Everybody from New York and Boston just was walking down here paying cash, outrageous prices. And so property values have literally almost doubled since the pandemic. And so you're looking at a situation where, it depends on what your portfolio is, but if you've got $1 million house and a $500,000 portfolio, it's almost kind of crazy not to consider the house. And I think that when financial planners in the past have been said, hey, teach it, it's your house, it's not an asset, it's because there was a fear of losing it. If you mortgage it and then you've got a payment and you can't make the payment, then you lose your house. With the HECM, you don't have a payment. And so you really don't have that fear of losing the house because you're not going to be late, and they're not going to come knocking on your door saying, hey, where were you the last 6 months on the payments? Without that monthly mortgage payment, you don't have that fear of being foreclosed on.
So then in that case, though, Bob, when we're looking at, these homes appreciating and just the massive increase in them, does the lender get all of that home appreciation in the case of a HECM, or how does that work?
No, actually what happens is once the loan is established, then it's disconnected from the property value. So let's say you start a line of credit or you're taking out a monthly check. The only time that we consider the home's value is at closing. We want to know what the value is at the time of closing. If the property value goes down after that, it doesn't change the parameters of the loan at all. It doesn't change any of the numbers. It's totally disconnected from the property value.
But I want to mention this too. A lot of people we hear when we talk to our advisors, clients want to pay their home off. So when they put their head on the pillow, they don't have a payment and they own it all.
Yep.
Okay. But look at the HECM concept. Okay. They don't have a payment anymore. That's what we just said, right? And that's why I think this is beautiful. It sort of does the same thing, and you got to get them to a point where you don't have to own it all to stop your mortgage payment, maybe, right? I mean, that's where I think we get. I mean, that would make them feel more comfortable, or at least open their eyes to listen to something like this. What do you think?
Yeah, and I think obviously it comes down to how big is your portfolio. I think that the sweet spot is probably 500,000 to 3 million in terms of when I can have an impact on that portfolio and the longevity. If you've got a $6 million portfolio and a $200,000 house, there's no reason to talk to me. I'm not going to be able to do anything for you. But if you've got $1 million property and a $500,000 portfolio, or if you've got $1 million property and $1 million portfolio, I'm going to have a tremendous impact on the overall longevity of that portfolio and the amount of income that you can draw. And ultimately, it can even increase your legacy if it's done properly.
Can you give us some general guidelines, though? Like, talk to a little bit about like 62, and maybe take an example or like a sample property, Bob, and just give us like, hey, if you had this mortgage, how much what could you do if you wanted to purchase a HECM or something like that? Could you walk us through it simply?
Yeah, so let me start by just sort of describing the HECM, what it is. I've said it's just a mortgage, and the way that we did work is we say, all right, baby boomers, retirees have paid down or paid off their mortgage, so they've got all this equity, but you can't spend equity. And so what we're doing is we're allowing them to borrow against the equity they've built up in their home without that monthly mortgage payment. All the payments are deferred until you move away, sell, or pass away. Now, the way that we determine how much money is available is it's based on 3 factors. One is your age, and we use the youngest borrower. The other is the property value up to our property lending limit is 1.25 million. Anything above that, we're not going to change the numbers if you have a $3 million property. And so once we know how much money is available to you, then there's 3 ways of dispersing it. There's cash at closing. We have to pay off any mortgages you have, any liens on the property. There's cash at closing. There's a monthly check. And that monthly check can come to you for as long as one of you remains in the home. Or you can do a term check, a larger check for a term period of maybe 5 years or something like that. And then the most exciting one actually for me is the line of credit, because the line of credit, if you use that option and you don't use the line, grows in availability annually. And it grows at the same interest rate as the rate on the loan. And this is where some of the financial planners are kind of like gobsmacked by it, right? Because if you start, let's just kind of do some ballparks. At 62, if you have a $750,000 house, you might get a $200,000 line of credit. Now that's okay. So what? If you sit on that and you don't use it at 85, you're approaching $800,000 in that line of credit. And so you can use that to self-insure for long-term care if you don't qualify. There's just so many things. And that's why I like Retirement Analyzer, because once we get those numbers, then let's go into Retirement Analyzer and let me show you how I can impact your portfolio. Let me show you how I can impact your overall, just your retirement plan and how much income you can have when you add a reverse into the picture.
Bob, I got to give you credit too. That's one thing I love about you is I know you're in this HECM space and that's really your expertise, but he's been to 2 Retirement Analyzer boot camps. So, if you're an advisor listening to this, he knows not only, how to build the HECM, but then he knows how to implement it back into RA to really show the client how it's going to benefit them. So I love that part of you.
That's been a huge help to me because I'm able to show a financial planner, not just say, hey, no, really, if it does, it turns into 800,000, I promise. I can show it to them and they can see it. And your red line solve issue, I mean, I'm sure we'll get into talking about that, but that is just a phenomenal concept.
Well, that was a big deal. During our prep, Steve brought that up, right? He brought up the concept of like, hey, let's say you have a client who's got a shortfall, right? And they got a red line, and what do they do? And if they happen to be a homeowner, Steve, I'll let you take it from here. But like looking at this reverse mortgage concept, it could be a solve.
Yeah, let me give you a quick example. And Bob, you tell me if I'm bringing this across okay. But let's just say that you have a $600,000 property. Okay, and we get back to these people that love to pay their house off, right? And so basically, there's $100,000 mortgage. Let's say real simple numbers. Let's say it costs 1,000 a month. Let's say it costs 1,500 a month, and that $18,000 is kind of draining. Real estate rich, cash poor kind of thing. They need some cash flow. That $18,000, right? They could stop paying that, right? And this is, I guess, an initial form of a HECM would be what? I don't want to pay off the $100,000. Okay, let's say there's two things they could do. They have their portfolio, and they could take $100,000 out of their portfolio to pay it off and stop that 1,500. That gives them another 18,000 of cash flow. That's good, right? Or they could simply stop, keep the money in their portfolio, okay, and take a HECM on this. And instead of the mortgage going down to a point where you pay it off with the $1,500 payments, it starts to slowly creep up. If the house is going to be sold when they're not here anymore, they have to get used to the fact that, hey, you know what? I don't have to make this $1,500 payment anymore. I can live in a house for as long as I want. And that's a different way of thinking, I think, a little bit. But I got to tell you, it's amazing. In Retirement Analyzer, if I stop that $1,500 payment, a lot of times it makes the analysis so good, it could alleviate a situation where they run out of money. So just stopping that,
Yeah.
whether you pay it off or not, I think is a big deal. Yep, could be.
Yeah, and I think that is immediate. You see it right away in the scenario, right? You take that 18,000 out. And then the thing I also point out is go ahead and look at the tax tab, because if that's a qualified plan that's paying that 1,500, guess what? You just save some IRMA, you just save some taxes. I mean, there's a lot of other things that might come into play. It depends on their situation. But then the other thing is if they don't have a mortgage, you can add an income stream with a HECM. So if you're thinking like, let's say a 73-year-old, and I usually do 73 because that's when RMDs come out, right? And so a 73-year-old with a $1.25 million house gets about $38,000 a year on a monthly payment. And so you add 38,000 to the plan, and again, that red line will probably disappear. So there's both sides of that, and that is you can either eliminate that mortgage payment, but if you don't have a mortgage, you can add that 10-year payment and really see some good things. And then the fun part for me is take it out, and if you're comfortable for a few years, let that line of credit grow, and then do a 10-year payment, and then you've got a bigger amount of money, and so that check just increases in size, and it really gets to be pretty exciting.
Bob, let me just ask you a quick question. So last episode, we talked about being your own bank in a life insurance policy by overfunding the life insurance policy, and you get the cash value that you can access. I mean, it's the same kind of thing here with the HECM, isn't it, though? I mean, you're creating a pot of cash that you could use or not use, depending upon if you need it or not. Is that correct?
Exactly. Yep. It sits in the background, and that's the great thing about RA is you can see it in the protected asset there. It's sitting there growing, and if you don't need it, great, onward ho. But once that problem comes up, right? Once at 85, somebody needs $20,000 a month for 3 years for a senior living situation, a skilled facility. Then all of a sudden you look over there. Oh, wait a minute, that protected asset at 800,000. I can engage that and keep the portfolio intact. It really is pretty exciting to see.
And Bob, I want to circle back to something you had touched on, just looking at the overall plan, but will this HECM reduce the Social Security or Medicare benefits at all? Does it affect that?
Doesn't impact at all. No, it might have, for a financial planner, it probably never happened. But if you're on like an oil assistance program or something like that, and you take a check, it might have an impact. But in terms of Social Security, no, doesn't impact IRMA. It doesn't really have an impact because it's not really income from an IRS standpoint. It doesn't go onto your taxes or anything on that line at all.
Beautiful.
Have you seen anybody, we talked about like how real estate values exploded, right? Like, so there, houses that were worth, let's just say $500,000, before the pandemic, also are worth $1 million. Have you seen anybody all of a sudden go, wait a minute, if I did one of these, I could basically pay off my house now, and take advantage of while I'm young, what Steve was just describing, get rid of that mortgage payment and basically not have a mortgage payment for the last 50 years of my life or whatever. Have you seen somebody take advantage of it in that way?
Yeah, it's actually interesting. I had a guy, Wade Pfau is kind of a famous financial planner, advisor, teacher, and things, and he's big on the reverse mortgage. I had a guy call me up. He said, I just read Wade Pfau's book, and I want to do a reverse, and I want to put a line of credit in place, and I'm going to actually pay the closing cost out of my pocket because I want to have a $300,000 line of credit with the $50 balance growing at 6.5%, so that down the road I've got all the money I need to handle it. It was very exciting. It's not very often that I get that, but every once in a while I'll have somebody go, "Hey, I want you to do what I already know I need to do," and so it does get more and more exciting.
Yeah. Are there any long-term limits on it? Meaning, so let's just say somebody who was 40 years old and came and did this, and they might live to 100.
They can't. 62 is the earliest. You have to be.
Okay, there we go. This is good information. 62 is the earliest.
Yeah, 62 is the earliest, and actuarially, they've figured it out. They only give you about 30% of your home's value at 62, and it goes up to as high as maybe 65, 70 if you're in your 90s. So it's a sliding scale. Ultimately, we don't want you to be upside down on your home, and so we're not going to give you too much money to get you into too much trouble, if you will, and put you in a position where you're upside down.
So basically, the millennials and Gen X's or whatever, just calm down, pipe down. You got time. You can't do anything yet, right? I'm with you.
But you know
Hold your
it's there
horses,
when you get
Langford,
there.
right? Hold your horses, Langford. You're getting a little too excited on this side of the camera, is what you're saying to me.
Mike's going through an example here. Like, wait a minute, I can make $1 zillion.
I'm like, wait, I got ideas going through the dome right
Just
now.
so you know, there is a proprietary product that goes down to 55 in many states. So there is an option there. You have to kind of really evaluate that one because, again, your line of credit, your balance is growing from 55 to 95. So it needs a little more evaluation.
And Bob, talk about, I know there's hoops to jump through with getting one of these, put into play. So talk about some of the basic rules as far as I believe the home has to remain in sellable condition. They have to have some counseling. You want to walk through some of kind of those guidelines? Yeah.
Yeah. So some of the protections that are built in, number one, anybody that does a reverse mortgage has to go through a counseling session with a counselor or credit counselor who's not affiliated with the mortgage company. Usually takes about 45 minutes on the phone. You can have your kids on there if you want as well. But they want to make sure that you understand the loan, and they don't want me to be the only one educating them. And so they go through it. They help you understand it's got to be your primary residence. We don't lend on a second home or a vacation home. So it has to stay your primary residence. You have to be able to pay your property taxes and your homeowner's insurance, any HOA fees, that kind of thing. And then, as you said, you have to keep the house from disrepair. And we're not talking about, redoing the carpets because it's a different decade now and you've got to have different colors. But we're talking about the bones of the house. If you have a tree fall on the roof, you have to fix it. You can't just put a tarp up there. You've got to be able to keep the house from disrepair. But ultimately, if you do those things, then you're really in a position where we can't foreclose on you. If you're paying your property tax, your homeowner's insurance, even if that line of credit has grown to be greater than your home's value. And so let's say your line of credit has grown to $1 million and your house is worth $800,000. You literally can say, give me $1 million. And we can't say, no, your property value dropped to 800. We're going to make it 800. They've got that fund is guaranteed and irrespective of what the property value ultimately comes out to. Now, it's difficult to get there. I certainly don't promise that to anybody. But if that were the case, then we cannot cancel that line of credit or even hinder it in any way, unlike a HELOC where the banks, when property values drop, the banks go, hey, your HELOC is canceled because it doesn't support the value anymore.
It's an amazing feature, I think, of it. It really is, that it actually increases no matter what the value of the house is. I think we have to warm people up to using this home equity, though. I think a lot more work has to be done. I think we've come a long way last 10 years or so, but I think this is an amazing concept. And Bob, tell me if I'm wrong here. The house will either appreciate or go up or go down. Not it really has nothing to do with the equity that you have in it.
Right. Once you're in, the house can go up, can go down. It doesn't matter. The line of credit, if that's your option, or that monthly check. Again, if that check is coming to you and we've given you more money than your house is worth, we have to still keep sending that check.
Yeah.
It's guaranteed by the federal government, and it's irrespective of property values.
So basically, appreciation in a home has nothing to do with the loan on it.
Yeah, you could say that it's a hedge against housing market volatility in that sense.
Yeah. Yeah.
So then walk us through, let's say the home appreciates from what the initial loan amount was. Walk us through what happens on death in that situation.
Sure. So at the point at which the last borrower leaves the home, whether move away, sell, or pass away. So let's say they both pass away and the kids are now, all right, I've got a decision to make. They can look at it and say, all right, do I want the house? And so sometimes on the Vineyard and Nantucket or the Cape Cod, they're like, oh, that's an estate. We'd really like to have that for the summer. Okay, if you can afford it, great. So they have to pay off the balance of the loan and they can keep the house. Most of the time, as we said, they want the equity in the home, but they don't want the house. And so they put the house on the market, and we give you initially 6 months to sell. You have to communicate with us, right? You have to say, okay, mom and dad have died. We're planning on selling. We'll give you 6 months to sell the house. And if it's not going well, you haven't sold it yet, but it's on the market at a fair value, we extend that out to a year. So you're not in a situation where your kids have to do a fire sale. They can take some time and put it on the market, maybe stage it or whatever they need to. But basically, once they sell the house, they pay off the lien, and whatever equity remains is for your heirs. So they get that in return. So it's all, it all goes for where the loan is at the point at which you pass away, where the home's value is. So if the home screams in value, your kids get more money. If the home goes down in value, they'll get less money, but they'll never get a bill.
Yeah.
Amazing.
Let me ask you this, though. What about a situation where somebody's going into a facility? Let's say it's the last spouse, whatever, goes into a facility. When does that period start, that timer start, when they determine that they're not coming home anymore? Or what happens then?
Yeah, so once you're out of the home for whatever reason for 365 consecutive days, then the loan becomes due. And so I always tell you, you've got to be able to let your kids know, because if you have dementia and you're going to a skilled, you're not going to be able to go, oh, wait a minute, tell the kids to sell the house. That's not going to happen. So you want to make sure your kids understand, hey, if mom and dad end up in a skilled facility and no longer in the house, you've got 12 months again to sell the house, and then you can use the equity in the home to pay the skilled or whatever the situation is.
Really interesting. We talked about during our prep call that you could use life insurance. It kind of bridges our last episode. You use your HECM funds to basically fund life insurance that'll pay this thing off when at the end, right? So you still have the flexibility of keeping the home should you wanted to, right?
Yeah, so one of the things that I also do is sometimes those life insurance policies or the long-term care policies become prohibitive as you get older and the portfolio is a little bit. Well, you can use the HECM to pay those premiums. And it's a wonderful way of using it, because if you're using, let's say, half of the funds for a life insurance policy and half of the funds for your income, that life insurance policy is most likely going to be able to pay off or at least pay down your balance, so that when your house does transfer to the kids, that life insurance has an impact on that, ultimately on the loan balance. You can pay it down. So it can be a really powerful tool, whether you're looking at sort of funding long-term care insurance or just a life insurance or a hybrid where you've got the life insurance policy with a rider for long-term care. Funding that and using that to pay premiums can be a really powerful tool.
Oh, I love that. Now, one more. Sorry, my brain is just swirling here. In the situation with a husband and a wife, if one spouse dies, what happens with the second one? Do they automatically have to leave the home? Do they have to deal with the mortgage? Talk a little
No,
bit about
as
that.
long as one person is still in the home from the original loan, then nothing changes. Again, if you've got a check coming in, that check still comes. If the line of credit is there, you can use that line of credit and you can do things on that line. That's nothing changes as long as one of the borrowers remains in the home.
Beautiful.
This is my favorite, though. We have to touch on this though before we're done here, and that's the HECM for purchase. So we get a lot of this when people call up about their client files and they're asking questions. A lot of times what people do is they'll either downsize or maybe they'll upsize. Okay, so what do? They might sell a house for $700,000. Okay, let's say they buy another house for $700,000, and let's say there's 68. What if and they'll plunk the $700,000 that they sold the first house from into the second house and pay it off, and there's no mortgage. And Bob, I'm going to just open this up for you here. Just give me 1 second though. Okay. So basically what if they only want to pay, they want to put $350,000 down and have a home equity conversion mortgage and never have to make a payment. So let me just, instead of putting the whole 700 down, we're going to put 350 down, take the mortgage. We're older. We never have to make a mortgage payment, and then keep the 350 and go invest it somewhere. So can you speak on that, Bob, a little bit?
Yeah. So as long as that works from an age standpoint, right? The percentage that they have to put down is based on age. So you'd have to be a little older to be at a 50% range. But yes, you can do that, and it ultimately gives you more cash to work with in your retirement. You don't add a payment because you're using a HECM, but you're paying less down. What I'm seeing, though, is in particular on the Cape, it's almost impossible to downsize because by the time you sell, you pay off your mortgage, you pay the realtors, et cetera, you may be walking away with enough funds, but you turn around and you go, do I like a house at that level? No, I don't, not at all. And so what we're really seeing a lot is upsizing and using the HECM to upsize. So let me give you a quick example. I did one recently. The client was moving off the Cape. They were in a condo. The assessments went up. Their HOA fee went to $1,000, and she was done with it. I want to move. And so she's moving up towards Boston. And I was like, okay, this is not going to go well. But she found a house for $740. And so she didn't even have to use all of the $563 that she got from the cash. She only needed to use about $450 of it. We gave her $300. She had $500,000 in equities. So she could have taken that out to cover the balance, but then there would be a tax hit. So what we did is we gave her the funds to upsize. She didn't have to use all her funds. She kept $120,000 of cash from the purchase or from the sale of her home on the Cape, bought that new house near family, doesn't have a mortgage payment, portfolio's intact, $120,000 extra in cash and no mortgage payment. So upsizing is even more exciting. And I think most financial planners would go, yeah, I'd rather have them do a HECM than take $300,000 out of the portfolio.
Conserving the funds. Great thing.
I love it. All right. It is time, I think, for our favorite topic, which is retirement BS with Brooke and Steve and Bob. So I'm really excited about this one. Now, I originally had, when I wrote up our outline for the show, I had a different idea in mind, but over the course of our conversation together, another one popped up for the BS segment. So none of you are prepared for this, but I think all of you are going to hit this one out of the park. So my retirement BS segment is the HECM/reverse mortgage is only really appropriate for your clients who absolutely need it and have no other option to make their retirement work. What say you? Is that BS or is that a good statement?
I'm going to quickly say BS and I'll let Bob explain the why.
It's kind of interesting because I think the original intent of the reverse mortgage was for that, right? It came out of some economics studying by a professor at UCLA. And what he was looking at is he was looking at retirees, and most retirees in the United States were living below the poverty level. But if you added their equity into the picture, they rose up out of it. And so, yes, the original intent was to kind of help the widow put oil in her tank during the winter. And so, but that's the original intent. The financial planning world has gotten hold of this, and really since 2008, 2009, they've gone, oh, we got some ideas here. And so now we use it in portfolio management. We use it in, long-term care. We use it in moving. We use it in divorce. It's got tax strategies. It's got Social Security strategies, delaying your Social Security till you're 70. I mean, there's so many things that we're doing with it now that it's a really limited view to think, oh, it's for the widow who can't put oil in her tank. It is, yes, it is that. And I do, probably majority of my loans are for those who are trying to live on Social Security alone. But once we get into the financial planning world, no, that's definitely BS.
After careful consideration, I'm going to agree with Bob.
This BS from Steve. We got BSs across the board. I absolutely love this is fantastic. This has become a fan favorite segment. People really do enjoy this a lot. Okay, Bob, one last word. If an advisor is listening to this episode, finished listening to or watching, and does one thing differently with their next client meeting, what would you suggest it is based on their new knowledge about this?
Yeah, I think bottom line, it comes down to have the housing conversation. And then one phrase that I think is really kind of a key phrase: how comfortable would you be safely leveraging the equity in your home to accomplish your goals? Because that ultimately, that says that's how we're going to do it. We're going to responsibly engage your equity in your home to accomplish your goals that we may not otherwise be able to accomplish. And so if a financial planner is thinking about his next meeting with a client and he hasn't had the housing conversation, that's the thing I would say. Have the housing conversation, and then let's think about how can we incorporate equity into our plan to enhance the outcomes.
If I could just say this too, I just think it's such a big plus to open up these pools of money that you might need somewhere in the future. We talked about life insurance on our last episode about the cash value. This here, it's just a different way of thinking. I mean, that to open up the pool of cash that you have in your home if you need it. And to me, Bob, I mean, I know it's a little bit of a price to pay to get these things set up, but to me, it's well worth it if you just look at what you can do with it. So I think, we spend some time over the next 5 years or so trying to change. I don't know if it's the narrative, but people are still a little nervous about it. But when they start to see what it can do, I'll tell you, it changed thinking, my opinion.
Such a fantastic tool.
Yeah, I think what I do with my financial planners is I also give them something they can put in front of their client. And I encourage them, show them what it does before you tell them what it is. And that's where, again, RA does a phenomenal job. Show them what it does. And then, then it's palatable. They go, okay, I see it. I understand it now.
That's fantastic. That's fantastic stuff. Well, advisors in the audience, we want to hear from you. What types of conversations and success stories have you had helping your clients tap the equity in their homes using HELOCs and HECMs and reverse mortgages and the like? We want to hear what you've done, because this has been a really vibrant conversation. And I think it's a testament to what modern financial advisors are doing. They're getting way more innovative, right? They're not just managing your portfolio anymore and slinging product, right? They're actually helping you achieve your retirement goals. Well, Bob Tranchell, this has been a fantastic conversation. You were an amazing first guest on the show, and I think made everybody excited to get more guests, but no one will live up to you, Bob. Just letting you know.
Thank you.
If people want to learn more about Bob, by the way, before we let you go, Mutual of Omaha Reverse Mortgage, the new HECM.com. We'll get that linked up in the show notes. And phone number. He was willing to give us a phone number. We got 833-411-HECM. We'll get that
Hold
linked
on
up as well.
And Bob answers the phone. He does.
He answers the phone, just like that's right.
Yes.
Exactly stuff. All right, guys. Well, this has been absolutely fantastic. Before we let everybody go, please do make sure you like and subscribe to the podcast on Apple Podcasts, Spotify, Amazon, the YouTubes, or wherever you like to get your podcast jam on. We want to make sure you don't miss another episode. Fantastic stuff. Thank you, guys. See ya. Bye.
Thank you.
Awesome.